In last video we discussed surface level concept of derivatives. In this video we'll discuss it deeply. We'll break down the futures market, explain key concepts and provide simple examples to help you grasp the concepts better. So let's get started. Futures market is a financial marketplace where participants can buy or sell contracts that obligate them to buy or sell an asset at a predetermined price on a specific future date. These contracts are called futures contract. Futures contracts are widely used for various underlying assets including commodities like gold and crude oil, financial instruments like stock market indices, and even foreign currencies. Let's understand how futures work with a simple example. Suppose you are a farmer who grows wheat and you want to ensure a stable price for your wheat at harvest time. You can enter into futures contract to sell your wheat at a fixed price on a specific date in the future. On the other side, there will be a buyer, say a bakery, who wants to secure a stable price for wheat to make bread. They enter into futures contract to buy wheat at the agreed upon price on a specified date. This contract helps both parties manage their price risk. The farmer ensures minimum price for their wheat and the bakery locks in a known cost for purchasing wheat. When you enter into futures contract, you don't need to pay the full value of the contract upfront. Instead, you are required to deposit a small percentage of the contract's total value known as margin. The margin acts as a performance bond to ensure you fulfill your obligations under the contract. It also allows you to control a more substantial position in the market with a relatively smaller initial investment. In the futures contract, there are two main positions, long and short. If you enter into a futures contract to buy an asset, you have a long position. You hope the asset's price will rise so you can sell it later at a profit. On the other hand, if you enter into futures contract to sell an asset, you have a short position. You are expecting the asset's price will fall, allowing you to buy it back later at a lower price, thereby profiting from the price difference. Every futures contract has an expiry date, which is the date when the contract comes to an end. In our wheat example, the farmer would deliver the agreed upon amount of wheat to the bakery and the bakery would pay the fixed price as per the contract. While futures contracts are often used for hedging purpose to manage price risks, they are also used among speculators. Speculators trade futures contracts purely to profit from price movements without any intention of taking physical delivery of the underlying asset. For instance, if a speculator expects the price of crude oil to rise, they can buy a crude oil futures contract at the current price and sell it later at higher price, making a profit from the price difference. Understanding futures contracts can help you make informed decision and manage risk effectively. If you found this video helpful, give it a like and subscribe to this channel for more videos like this. Thank you for joining us today and we will see you in the next video.